Good afternoon, everybody, and welcome to another Hamilton Wealth Partners Fund Manager webinar. My name is Kane Barano, and I'm a principal at Hamilton Wealth Partners. So the format for today's webinar will be the same as previous webinars, and I'll begin by reading a brief advice warning, then introduce our guest speaker and hand over for about 30 to 40 minutes. We'll open up for questions at the end of the presentation, but do feel free to submit any questions you have in the taskbar below throughout the webinar. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking account of your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate having regard to your objectives, financial situation, and needs. So today I'll be joined by Patrick Russel from Northcape. Now, Patrick has over 30 years investment experience and is the portfolio manager and analyst for the emerging market equity strategy at Northcape. Before joining Northcape, Patrick worked at Merrill Lynch for 18 years from 1989 to 2007. At Merrill Lynch, Patrick was a managing director within the global emerging markets research team and was head of Asia Pacific Telecom and media research team based in Melbourne. Patrick holds a Bachelor of Commerce degree majoring in economics from the University of Canterbury and has completed postgraduate studies in developing country economics and investment analysis. So with that introduction, I'd like to hand over to Patrick.
Well, thank you very much, Kane, and thank you everyone for joining on this afternoon. We're really looking forward to giving you this presentation today. So without any further ado, I'll go into it. As mentioned, the slides take about 40 minutes, and what I'll do is just sort of give you a little bit of outline on Northcape as a whole, and then focus in on the EM asset class, why invest in that, and then talk a little bit about our process, how we go about navigating the choppy waters of global capital markets, in particular EM, and finally give you some examples of some of the stocks that we own in the portfolio before I kind of wrap it up with how we're kind of managing COVID risk from a portfolio construction standpoint. So I'll just try and share the screen now with you. Hopefully this will come up, and please sing out if it doesn't. So if we look at our motto as a firm, investment performance ultimately depends on
I don't think the slides are showing up. Do you want to try share?
Yeah. There we go. How's that?
Yep, we're on.
Yes, so really the motto of Northcape is investment performance ultimately depends on human judgment. So we're not a investment firm that's focused on technical analysis or computer programming to run algorithms to kind of second guess markets. Our focus, and primarily in our DNA, is fundamental research on companies. Finding good investment opportunities, and we do an enormous amount of research in the field. We don't sort of kind of collate data on computers. We're actually out there in the environment interviewing companies, whether we do that virtually at the moment, but in the past we've done most of it physically. And in the case of EM, we have an enormous amount of interviews every year. We interview around about 500 companies and various people associated with the asset class. So over the past 12 years, we've built up this huge amount of experience, and that ultimately has enabled us to create some very, very strong capability to give good judgment in our decision making in the asset class. And ultimately, that's exactly what you're investing in with us, is our ability to continue to make the right decisions. So if we move forward a little bit about Northcape as a whole, we are a private company. We're 100% employee owned, so we're not controlled by a bank or any other external party. And that's important because we think ultimately we align our objectives of the business with that of our clients. Too often, funds management companies are owned by banks or even listed equities, funds management specialist groups. And really, they want to just maximize assets under management and profits. Whereas, whilst we understand profit is important, ultimately the success of our business comes down to having successful long-term returns for our clients. And that's why we think the very best funds management businesses are 100% employee owned and private, and therefore we can control our own destiny. And as a consequence of that, we've set very explicit capacity constraints on all our strategies. And what I mean by that is that we limit the amount of money that our funds can run, so we don't end up running too much money, and then we can't kind of trade our strategies as well, because we just are basically constrained by too much assets under management. And this is particularly important in EM. The other point I'd notice with our 3 strategies that they're all single strategies. We don't have multiple funds. And in the case of EM, we only have one fund. And a lot of our competitors, they will have multiple EM funds. For example, they might have a global emerging markets fund, they might have a China fund, an Asia fund, a technology Asia fund, various flavors and derivatives of what they might have as a master fund. And we think that just dilutes the effort. So we'll only ever have one fund. And this is what we live, eat, and breathe. So as an investor in our strategy, we've got that single focus alignment. And we think this is very powerful in terms of our ability to keep prosecuting good returns over the long term. The other point is we have offices in Melbourne, that's where we're based, but we also have a research office in Tokyo, which we use as an extension of our platform here. And that's been very important in terms of increasing our information net. If you look at our assets under management today, we have in the emerging market funds about $5 billion, which is about just under half of our total assets under management. We have a wide array of clients that have been with us for a very, very long time. In fact, we've never really lost a client. In fact, all our clients have come in and they've tended to add to their position within our strategy, and that's been particularly gratifying over time. And whilst most of them may have a conscious view about relative performance, at the end of the day, what we're trying to do, and this will be very clear when you look at our performance, is grow the corpus of funds for our clients in real terms. And that increases your real wealth over the longer term, but do it in a fashion that is not volatile. So you get those consistent returns. And a hallmark of our strategy is the fact that we've really been able to get these high returns, consistent returns over the longer term, but with much less volatility than our peers and also the market as a whole. And also I would highlight that all of us as PMs, portfolio managers, are all significant investors in these funds. And a good percentage of my total wealth is actually tied up in this EM strategy. So that's another important feature in terms of the alignment. And that, funnily enough, doesn't often exist in a lot of other funds where you don't actually get the PMs as very large investors actually in the fund. Finally, I just point out that we take governance extremely seriously in this organization, and we became a signatory of the UNPRI late last year, and we think that continues to create the disciplines around our ESG research, which is a real cornerstone of what we do in EM, and I'll come on to that in a moment. So just to sort of highlight EM, and you may be wondering, well, why should I invest in emerging markets? And here's a little kind of trio of stats worth focusing on, is that today EM is around 12% of global stock market capitalization, but it is 70% of natural resources and 85% of the global population. And we just think through those factors alone, you're going to see the global market cap continue to grow in the relation of the EM share. And one of the big factors that underpins it is demographics. And here's a couple of examples. If you look at Japan, this is the population pyramid, and you can see here, this is the age brackets on the left-hand y-axis, and this is the percentage. And this is a very typical advanced country population pyramid, and it's awful. Because basically you've got all this cohort of older people, but a very under-penetrated cohort of young people. And that is a recipe for economic decline, because basically you have a situation where there's no natural growth in demand. And you've got more and more older people who basically leave the workforce and they start saving. And once you start saving and that imbalance gets out of line, it basically starts contracting GDP. And that in itself is, essentially why Japan has had chronically low growth for some time, is actually poor demographics. By contrast, if you look at India, this is a beautiful population pyramid. You've got a massive bulge here below the age of 25. Now, this is a population pyramid, which is in a way very pregnant consumption growth, because all these people here below 20 are gradually going to join the workforce. They'll get married or get a partner, they'll form a house, they'll buy a car, they'll buy a laptop. That's all latent consumption growth that's sitting within the population, okay? So that's actually going to be a very powerful tailwind for sustained economic growth. This is horrible. So if you're investing in a company that's addressing this market, they're actually addressing a shrinking market just by the population alone. And the only way you kind of can recover that is by massive productivity growth, which is quite hard. Here, you've actually got a massive tailwind for economic growth just in terms of the demographic dividend. And it may actually be even faster than that if you've got productivity growth as well. So this is, in a nutshell, probably the kind of key factor as to why EM continues to grow at a faster rate than DM in our view over the past 20 years. And we think so over the next 20 years, and justifies maintaining a healthy portfolio weighting. So if we look at it here, the index for EM, the genesis or the inception of the index was way back in 1988. We only had 1% share of global market cap. And it's risen to 12% of a much larger market cap. So there, by way of example, is the growth in the capitalization. That has been achieved by more companies obviously listing, but it's also been achieved by phenomenal returns from some of the leading companies that characterize the EM index. Importantly, there's only 26 countries in the index. Okay, so there's a lot of countries that you would say are developing that don't qualify for EM, and they don't qualify because they don't meet these necessary conditions about economic development, size, liquidity of the stock market, importantly, market accessibility, and also various discussions about aspects which are important to the investment community. And this really relates to institutional rule of law. So in a way, the asset class has been pre-vetted, if you will, by these conditions. But even with that, it is a very broad church, okay? And as we know, there's a lot of volatility within the various countries within this index. And if you're buying an ETF, actually you're immediately strapping on quite a lot of innate risk. that comes from this strategy. And the reason we've been able to generate good returns is that we've been deliberately selective in our approach to this asset class, which fundamentally can offer some exceptional returns, as we've seen in the growth and capitalization. But we're really focused on the best of the best EM strategy, the very best companies in this asset class, while managing downside risk. And we do that by basically having a strategy of which we basically coined a phrase, winning by not losing, okay? So we're like that team in the competition that is the most defensive team. I mean, I grew up playing rugby union, but it's the same in AFL and the same as soccer. Usually the team no one wants to play in the comp is the gnarly defensive team that almost wins by not losing. They're really hard to score a goal against. And that's the kind of way to play this asset strategy from our point of view. It's almost a contact sport in terms of the volatility. And by embedding defensive strategies, you kind of lock in the upside from the gold. So with that, you can see our returns here. And I'd highlight the fact that, yes, our relative returns have been quite strong since inception. We've beaten the index by nearly 8% compound per annum. And the index hasn't been really a particularly great returner, to be honest, and it's been quite volatile. And we've returned around 13% or just under on a compound basis over that period. That is significantly above the rate of inflation in Australia. In fact, it's well above what you would have got from the ASX 200 over that same period. So this is a lot of economic value add in terms of the investment strategy. But the thing is, what underpins our performance, you can see here way back in the GFC, we fell a lot less than the market there. We fell a lot less than when you had the blow up in China, and we've really significantly outperformed in the volatility of this year. And you can see that I've highlighted calendar year to date, we're up 21%, the index is down 3%. Now that's no accident. You know, essentially our ability to inoculate ourselves from those downdrafts is not a guaranteed factor by any means, but we've done a very good job of limiting that downside market capture. And that's kind of built our returns over time by limiting the losses in difficult years. And you can see that manifested here. I'll take you down the middle. You can see our downside market capture is 37%. So give you an example. If the market falls 10%, we fall 3.7, okay? If the market goes up 10%, we go up 8.5. So when markets are very strong and there's a lot of animal spirits and liquidity and markets are very buoyant, we will underperform the market, but we'll still give you a very strong return. But it's this downside market capture that locks in our returns, which then builds and compounds over time. And that gives you that really nice compounding return, which is significant over the longer term in terms of growing the corpus of your assets. And you can see this relative to our peers. This is from the e-investment database in the US. This is the largest fund manager database in the world. Each one of these dots is a major EM fund, okay? We're one of the bigger funds, but by no means the largest. Along the y-axis here, this is the return. Okay, so our returns are one of the highest. There's only one other fund out of the 100 in the world that have had a better return than us, but we've done it with much less volatility. So when you're investing, really nirvana is this quadrant here, okay? This is where you get higher returns than less risk. The index, by the way, is right there, that little blue dot. I don't know whether you can see that. And the crosshairs is the median of our cohort, okay? So this is the whole focus of our strategy now, is to keep our returns in this quarter better than the market on total return and better than the market in volatility. There is one fund that actually delivers a slightly higher return than us, but you're actually buying a lot more volatility, strapping on a lot more volatility to get that return. So how do we kind of get that return? And what we try to say is, look, you're not buying our returns. You can almost forget our returns, because if you're coming into our fund today, it's not about what we've achieved in the past, it's what we can do in the future. And one thing that you are buying, as I've mentioned, is the quality of our team, but our investment principles. And those returns, particularly our very strong downside market capture, are a reflection of our 8 principles. And our downside market capture comes from the fact that we have an unrivaled focus on ESG. And we find companies with very, very strong corporate governance are companies that are run very, very tightly, very disciplined. They have proper record keeping. They have proper risk management systems. They tend to be much more aware of their environmental and social risks. They tend to produce better quality products, better quality services, lower defects. Staff morale is higher, productivity is higher. And as a consequence of that, they just tend to generate better returns. So we think if you get this particular dot point right, you're a big way forward in terms of solving your investment decision. So this is really the cornerstone of what we do in our research. We try and focus on this considerably. And then we look for other factors, such as we want to see an alignment of management and shareholders, and you want to see management with a decent stake in the business. We want to see a business with a defendable market share. And we also want to see a business with strong balance sheet. What's unique about our strategy is most of the companies in our portfolio have no debt. No debt. Now, people would, some people have said, well, you're actually running the portfolio too conservatively. And we go, no. We know in EM, and you are in all developed markets pretty much today, the plate du jour is running from one exogenous shock to another. And the issue in EM, when you get an exogenous shock in the capital market, you can't raise debt or equity capital. So what ends up happening, if you're in a highly geared company in EM, you tend to be in a situation where you're selling the beachfront property at the bottom of the market. And you do that, that's permanent capital loss from which you'll never, ever recover from, okay? And that is a risk we refuse to put our clients in front of, point blank. So we've immunized our strategy in not investing in companies with high amounts of debt. We have some with a modicum of debt, but not much. We want to own the companies that when asset prices fall, they actually buy the beachfront property in the fire sale, okay? That's where you get intergenerational wealth creation of magnitude, geometric increases. And there's an implied option value in the companies that we own because of their superior capital adequacy. So if you think about it, where are the capital risk issues in EM? It's around the balance sheet, and the other one is around governance. Our analysis shows the companies where you've lost all your money, done 100% of your dough, the number one common factor is a governance breach, right? So if you get those 2 dot points right, 1 and 4, you're a big way forward to removing capital loss risks from your portfolio. You can't totally immunize them, but you can have a big factor in getting them out of the way. And then we try and focus on valuing the sovereign risk. In terms of the upside, the gold, we look for businesses with high returns on capital and good opportunities to reinvest in the core business. So we're investing in businesses that are just doing the day-to-day things really well. Okay, they're not constantly looking at mergers and acquisitions. They just take an opportunistic focus on that and really only to buy assets in very distressed markets. And then we're looking for them addressing the market opportunity of EM. And that's that demographic bubble that I highlighted earlier in the presentation, that wonderful tailwind of structural demand growth from the demographic dividend, and then the additional growth you get from productivity. Okay, so with these kind of 8 principles, there's only a small team of us, there's 5 of us. It makes life pretty easy because a lot of companies get disqualified because they don't meet these criteria. So it makes it very easy for us to prosecute our strategy and finding the best of the best. Okay, so we can remain laser focused on these best opportunities by using this. And what you get at the end is a hand-picked, high-quality portfolio of EM businesses that are resilient with clear opportunities to grow. And this is what can deliver this sustainable long-term growth in the corpus of funds. And we think that will beat the index as well, as it has done over the past 12 years. So I just can't re-emphasize this enough. You're not buying our returns. You're never buying returns in any funds management group. You're buying their process and you're buying their people. And this is what you get with us. I just want to elaborate on ESG. What we do here is we score every company out of 10 on environment, social, and governance. And if they fail this test, we terminate the project, okay? That's how important it is to getting this right. And in terms of environment, we want to make sure they're measuring their environmental impact. There's no point, if they're not measuring their greenhouse gas emissions, you're basically putting yourself in front of a contingent liability that could blow the company to smithereens, but you don't really know. So we put a lot of pressure on understanding whether they're measuring their environmental impact, and then secondly, is it independently verified? The other factor we've got to watch for an EM, are they deploying child labor? This is a red line which you can't afford them to cross because the whole business could be closed down if that happens. And then we want to know about board structure and accountability. And a big part of this is the fact that we want to see independent corporate law, which is prosecutable in a court which is not controlled by the government, i.e. you've got separation between the judiciary and the state. And this is where China lets itself down very, very badly. You don't have that separation, and you've actually got phenomenally poor accountability with investing in listed companies in China. So let's turn to the portfolio. Okay, this is a concentrated strategy. There's over 5,000 stocks out there, but we only have up to 40 in the portfolio. Today, we only have 35. So this is why it's the best of the best of the best. Okay, so we've got this very tight filtration system. But just because it's concentrated, we do have a healthy degree of diversification. The largest holding cannot be more than 10% of our NAV. We must have 40% maximum exposure to one sector, 35% exposure to one country, at least 4 countries in the portfolio, and at least 5 sectors. And we have to manage liquidity risk. We also have the option here to invest in EM companies that are domiciled outside of EM. For example, they might be listed in London or New York, but there is, in all intents and purposes, an EM company. But these protocols, if you will, or constraints, are really there for the client to make sure we don't get over-concentrated in one stock or over-concentrated in one sector or one country. And I think that gives you some additional comfort in our strategy in terms of managing risk. So I just wanted to highlight our process here. This is what we do. We opportunity screen through those 8 principles I've mentioned, okay? And that's how a small team can basically filter around stocks. And we have over 400 meetings a year. Then we identify 10 companies to do work on. And then they have to pass the ESG test. And then we do a detailed approval report on that company. And then it must go to the approval meeting, and it goes to the approval list if it's voted onto that list. That process on average takes 1 year. 1 year. Okay, so we don't see a company on a Monday and then we write an email on a Tuesday, have a meeting on the Wednesday, and start buying it on a Friday. It takes 1 year on average to get onto our approval list. And even when it's on the approval list, it probably won't even go into the portfolio. It will sit there as we continue to learn and watch. Because what we're trying to do here is discover and understand all the risks. The average length of pages of our approval reports is 100 pages. These are massive tomes. They're very, very detailed analysis of all the risks. When we keep going through and through and through, line by line by line, every possible risk we can identify before it goes on the approval list. We never get them all. It's impossible. But if you can get most of them, 80, 90% of them, you're a big way forward. But by taking your time on this process, it builds conviction, okay? And this is important because once you get more conviction, you can actually swing the bat and have a good go. You can have a decent weighting in the portfolio. If you've expedited the project over 2 weeks, you know in the back of your mind, oh, I didn't really, well, for instance, you buy a house, but you don't get the builder to check it, you know, that kind of scenario. You know, a bit of a blood rush type impulse buy. There's none of that in our strategy. So once they're on the approval list, they're then available for us to put into the portfolio. And how we do that is we basically use sovereign risk to adjudicate what kind of PE we would put it in or what discount rate we would use to value the company. And this is important because sovereign risk is manifested in the currency in EM. So we're not investing in Australia where you've got the one functional currency. We're investing in all kinds of currencies like the Brazilian real, the Chinese RMB, the Indian rupee, the Mexican peso, the Turkish lira, and so on and so forth. And we have to think about it as a functional currency in US dollars. That is our functional asset class. And you can see here the Turkish stock exchange, actually not a bad return in lira from 2005 to 2019, 109%, but only 5% in US dollars, and that's negative. And you've lost all that because of the decline in the Turkish lira. And that is really the irony of EM. You can invest in a stock market that's going up in local currency, but it's all destroyed in terms of your return back in Australian dollars, back in US dollars, because of the currency alignment adjustment. And that is the sovereign risk. So how do we manage that? Well, we rank the 26 countries in the EM index according to their economic capital markets resilience. These are what we determine as the most preferred countries. This is the middle ground, and these are the least preferred. And it's got nothing necessarily to do with economic growth. It's our judgment that these sovereigns in EM are more stable and impervious to an exogenous shock than these countries. So what we do is we put a higher PE. We value these companies at a higher rating than what we do for these. We want a lower PE. We want to be compensated for the higher sovereign risk we have. And as a consequence of this, we have 85% of our portfolio in the most preferred and middle ground. We still own stocks in Brazil and China and some of these other countries, but that's only 15% of the portfolio from our point of view. Now the index, the MSCI Emerging Market Index, if you're buying an ETF or a passive fund, these countries are nearly 70% of the index. So by nature, the index is actually incredibly risky because it's basically giving you dominant exposure to what we determine as the most risky cohort. So in practice, our strongest sovereigns, we put a lower discount rate on and a higher PE. So If we've got a company in Malaysia, Korea, and India, we might be using a P of say 20 for that group. That same company, if it was domiciled in China, Russia, and Brazil, we might be using a P of 10 to 12. So that basically describes in this sort of illustrated terminology how we adjust for that sovereign risk. And this has been very powerful tool for us because it really manages our strategy in terms of removing the foreign currency drag, which can confiscate a lot of those returns you get from local currency share prices. And we just don't want to do that. If we look at our performance, around 70% has come from stock selection and around 30% has come from country selection, managing foreign exchange risk. So it's an important value add. So where do we think about the outlook? Well, from our point of view, we are in a situation where we're fighting lower global growth, structural deflation, and the prospect of lower interest rates for longer, possibly forever. And it's really because of these factors. We've got aging demographics in developed countries, a la the population pyramid of Japan, which is very similar to a lot of countries in the advanced world now, which is shrinking the economy. We've got increased automation replacing labor. We've got rising e-commerce destroying retail, and we've got high debt levels in developed markets. In fact, there's a lot more debt consequence upon COVID. And then we've got these two other factors that are depressing growth. One is the recurrence of pandemics, which we think will be an ongoing feature in terms of exogenous shocks and have an impact on people's view about long-term growth. And this other one, decarbonization, is going to have a negative effect on economic growth. We don't think you can grow the global economy as fast as it did over the last 20 years and try and meet the target of zero carbon emissions on a net basis by 2050. It's impossible. That's going to have a drag on economic growth. So in an environment of lower economic growth for the next 20 years, really, you want to own stocks that have structural volume growth and pricing power. And that's the kind of stocks that we have in our portfolio. And we think they're going to become increasingly rare and sought after. And the valuation of those companies will continue to grind up. If growth gets scarcer and interest rates stay lower for longer, then PEs will rise. And that's been the phenomenon of markets. And we think these trends are deep-seated. In fact, you've got these two extra dot points added factors to the structural slowdown in global growth and driving deflation and lower interest rates. So if you've got a genuine growth business and it can keep growing and growing, the value of those cash flows in the outer years get more and more valuable. And that drives an even higher valuation on the company. And then added to that, see here, these are bond yields in advanced countries. You've nearly got half the bond yields in advanced countries negative. And there's every risk with these additional deflation drags of decarbonization and rolling COVID or pandemic risk that more and more of these interest rates go negative. But look at the interest rates here. They're much higher in terms of bond yields. These too are going to come down. Now, if these come down, that drives up the PE because your bond yield is a function of your cost of equity, right? So for EM businesses, you're going to almost get two bites of the cherry. You're potentially going to get PE expansion from global deflation. And then secondly, you're going to get growth in the value of the business if it is a structural growth business. And those are the ones that we're going to own. And they're there because we've got the manuscript from our 8 policy aspects in terms of our stock selection. So that's our portfolio today. Those are the top 10 positions. and I'll go through a few of them now, but these are really outstanding companies in their own right. I mean, you can Google some of them and get a better idea if you want. We don't often show these, but we are very secretive about our portfolio, but we just thought for the benefit to give you some color as to exactly what's there. I'll take a couple of examples here. You'll see here we've got two healthcare names. One is Top Glove and one is Harderlega, both based in Malaysia. We own these companies coming into the pandemic. Why did we do that? We had a long-term view going back 10 years that one of the big exogenous risks to the global economy was a pandemic. In fact, one of our analyst portfolio managers, Ross Cameron, he was a great reader of this risk, and he was the one in our team who said, we've got to have a high exposure to PPE companies to basically provide us the insurance if a pandemic, a significant one strikes. And that's exactly what happened this year. And those two stocks have performed exceptionally well this year. They're up around 300-400% and have been a big factor in our total returns, but we've had other stocks that have done very well. And that's the profit pool of those companies. We are maintaining big positions in those companies, even though we have sold quite a lot, because we actually think this pandemic is going to last a lot longer than what people think. Important point to note that the fastest vaccine in the world was created for measles, and that took 5 years. And that was actually a relatively straightforward vaccine. This is much more complex in terms of the makeup of this vaccine, the different strands of it, the potential mutation of it. And you're just seeing a number of these trials dropping out. We actually think there's a significant risk that there's no mass market ubiquitous vaccine until 22, 23. In which case, we're going to be in this rolling lockdown. We're going to be coming in and out of restrictions, and it's going to be a very difficult piece of healthcare public policy to manage for quite some period of time. And so we actually think the profit pool of these companies is not only going to remain elevated for this year, for quite a number of years off the back of that. So consequently, we feel that these stocks, whilst they perform well this year, have got plenty more upside over the next few years. The other area that we've invested in, one of our significant stocks, is TSMC. They are the largest semiconductor manufacturer, and they're based in Taiwan. And what's interesting in this company is that last year they finally eclipsed Intel in terms of producing the most powerful microprocessor chips in the world. And what's actually happened is Intel's announced that it's potentially going to get out of the semiconductor industry and migrate its enterprise semiconductor business to third parties. There is only one major third-party provider, that's TSMC. Now, to give you an idea, about a third of the market is covered by TSMC, around 60-70% is covered by Intel. So we think TSMC, this stock price has gone from Taiwan dollars 60 here, you can see, to 350, right? So what's that, 6 times? In the last 9 years. It's done all this largely through mobile and smartphones. And now this is only addressing 30% of the market. It's got the big opportunity of enterprise. This is servers, data, cloud, PCs, laptops, mainframes, all the big users of semiconductors, which are part of the Intel ecosystem, are potentially going to migrate to TSMC's platform. So there's a significant amount of upside in this stock from that structural growth. And we think the demand for IT is going to continue to grow quite rapidly from innovation, from automation. And then a good example is just, cars becoming more and more automated. The amount of chips that go into cars is going to increase 100-fold over the next 10 years. So the market they're addressing is growing and their market share is growing. So that's a very powerful story. And then we have an investment in Maruti Suzuki. This is the largest automotive company in India. It's 56% owned by Suzuki Motor Company of Japan. And they're a category killer globally in small compact cars. And these are ideal for developing countries, particularly countries like India. Now you can see here, India is deeply underpenetrated in car ownership. It's around 4% of the population have a car. As you get growth in incomes, you get growth in car ownership. So we see significant opportunity for car sales to rise in India over the next 10 or 20 years, and also through EV cars, which they have a strong partnership through their joint venture agreement with Toyota. Toyota was competing with Maruti in India, and they decided to close their business and basically merge their growth opportunity through Maruti. And the reason they did that is because of this. Maruti has basically built up demonstrative market share in India. You can see this in the amount of car dealerships. It's got 3,500 car dealerships in India. And these are its competitors. And this is not only important in terms of buying a car, it's important in terms of servicing, spare parts, providing contact points for learning how to drive, which actually is a big part of driver training is part of their platform. And it's made it almost impossible for competitors to come in. And you can see how their market share is rising over the last sort of 10 years because of this powerful distribution capability they've built up. We're assuming that its market share actually flatlines at this number, but even with that, we see very strong growth in earnings. And truth be told, that market share is probably going to go higher. The other thing is they've got significant capacity to grow their car volumes in terms of their manufacturing network. So this is a company that's in an unrivaled position to grow. And I just come back to it. This is where you are here. So we think Maruti could grow significantly over the next 10 or 20 years because of its unrivaled market position in terms of distribution, servicing, and production capability. So that's really the summary of the presentation, and how it all hangs together is our portfolio distributions. And you can see these are the sectors we're in vis-a-vis the index. Northcape, we're the kind of tealy color. So we've got a big overweight in IT. That's our big holding in TSMC and also in a range of other IT and e-commerce companies. We've got good exposure to healthcare. This is all this preventative healthcare. We're underweight banks. We're in consumer staples, but we don't own much in the way of materials, real estate. We're not in oil and gas because that's a legacy dying, basically an industry that's going to fade out under climate change in our view. And from a country point of view, you can see how we're significantly underweight China. And that's because of our concerns over corporate governance. Malaysia, we do have a strong weighting, but that's primarily because of that healthcare exposure. We don't have any investment in South Africa. We don't have any shares in Russia, which is not there. And we have overweights in these three markets here. So, with that, I'll leave it there. Hopefully that gives you a good sense of what we're about. In terms of just the final slide, you can see here on COVID how our portfolio construction works. And these are the sectors that you would say are most vulnerable to COVID lasting longer. And in the index, they're about 23%. In our portfolio, they're a lot lower. And then the sectors that kind of are related to COVID, healthcare and e-commerce, we tend to be slightly above market weight. Those are on the sort of the really biased sectors, but in this sector, we're significantly overweight. So what this means from a risk analysis point, our sectors that are sort of defensive in a COVID world are 2.4 times overweight the vulnerable sectors, where the index is 1.2. And I think that gives us an idea of that, how we've set this strategy, and it sits with our thinking and our belief. And we've done a lot of research. We've spoken to a lot of epidemiologists, a lot of doctors. We've spoken to pharmaceutical companies. We've spoken to distribution. Yeah, here's a little snippet from our research. Do you know that a vial of vaccine for COVID will need to be transported at 75 degrees below centigrade? Okay, so you need basically a purpose-built cold chain just to transport those vials. So these are just some of the problems that you've got in terms of getting mass immunizations done. It's hard enough to kind of split the atom and create the vaccine, but actually that's only a quarter of the job. The hard job is going to be on the distribution, notwithstanding all the misinformation about taking a vaccine. So we're very comfortable about how we're exposing ourselves to that risk. But if we do sense that a vaccine is coming, it's coming quicker, then we have the capacity to alter this risk-adjusted matrix and dial up more here and dial down there to give us that kind of fulcrum in terms of exposure to a recovery. So in terms of Northcape, really this is a bit of an advertisement, but it'd be remiss of my managing director who'd probably tell me off if I didn't go through this. But the bottom line here is you are investing in a very stable, employee-owned organization. We think that's crucial to having control of our strategies, and that we're not just driving assets to get profits and not thinking about returns. It's really important to manage your funds in optimal size. That way we can maintain our flexibility and keep those really strong returns revolving for the next 10 or 20 years. And most of our clients are perpetual clients. They don't really need the money today. Most of our clients are just thinking, I want you to preserve our capital for our children. That's the kind of typical client we have in our organization. In terms of our firm, we're financially very strong and we've got significant resources, but I must say what you have here is a very dedicated, disciplined and very passionate team. And hopefully today you get an idea of that passion from that presentation. But as long as we stick to our process, and this is key, those 8 principles are our roadmap, then, I can't write an IOU for those returns, but I would say that we're in a good position. We're putting ourselves in a really good position to keep those returns rolling forward. And really crucial to that is not putting you in front of capital loss risks, okay? Around governance and around debt. You kind of remove those two, we're a long way to protecting your capital. And then we just get those tailwind aspects that I talked about in terms of structural growth from demographics and then from the kind of businesses we're in. So with that, I'll leave it there. I've probably gone about 10 minutes over, but hopefully that gives us some time for some Q&A.
No, that was great, Patrick. Thank you very much. We've got a question here from Campbell. So Campbell said, with regard to TSMC, what is your view in respect of the US-China semiconductor competition, and specifically the risks that the US will prevent TSMC from selling to China, and the follow-on risk that China may take some action against Taiwan/TSMC?
Yeah, we think TSMC is like the oil of Saudi Arabia in terms of the US wanting to go and protect Saudi Arabia for the oil. TSMC is one of the most strategic companies in the world. It is the leading semiconductor in the world. It has a demonstrative market share. It's probably around 85%. Their only other major competitor in this space is Samsung, which has about a 15% market share. And this is the reason why Intel have decided they can't compete with TSMC. They're getting out of semiconductors, and not overnight. It might take a decade. But already the semiconductor protocol libraries are being transferred from TSMC to Intel. So they're now designing their chips in line with the libraries of TSMC. And that's important because basically TSMC is signaling that they're almost going to go lock, stock, and barrel Intel to TSMC platform. So what I think in terms of managing that risk, TSMC will probably over the time open foundries in the US. And then secondly, it will just migrate less and less from China to more and more of Intel. And we think the gains from Intel are significantly larger and from the enterprise market overall relative to what share they might cede in China. And I think, that's the risk. Yes, there is a risk that China might invade Taiwan. If that happens, we think it's extremely unlikely. The US will certainly step in. And you've seen there's a number of strategic arms sales that have happened from the US into Taiwan over the last 12 months. Our base case is that Biden will win. We might be wrong on that, but we do think he's probably too far ahead. Too much of the vote is done. And if Biden gets in, we actually think US is going to get even tougher on China and actually consolidate more of Fortress Taiwan, which will be to the benefit of TSMC. So yes, it is a risk, but we actually don't think it's a massive risk in the scheme of things. We think for all those reasons, it's certainly manageable in terms of how we value the stock as well. We think it's to a certain extent priced in.
Thank you very much. Just quickly, we've got time for one more. With respect to position sizing, maybe using some of those healthcare names that have run quite hard, how do you manage that risk? Obviously, the risk increases as the stock price goes up. So can you quickly just talk to your fade strategy if you have one and your selling price?
These stocks, particularly Top Glove, sort of approached 10% a number of times. So we've got a 10% limit on any holding, and when they typically get to about 9.5%, we sell. So that stops one position kind of getting too high. So that's kind of been our main sell. The other thing we look at is that we look at the earnings, and we're constantly updating the earnings for Top Glove. And what we're finding is that the earnings were growing at a much faster rate relative to the valuation. You can see here the quarterly profit of Top Glove has gone from 350 million a quarter to 1.3 billion to 1.7 billion per quarter. So that, honestly, even though the share price is up a few % this year, the actual PE has come down quite considerably. I think the other thing to note is that people think, oh, anyone can make these medical, surgical, hygiene gloves. No, they're actually quite hard to make. And the machinery for it, you can't buy it from a capital equipment company in Germany, for example. All the IP for the plant to make these gloves is actually proprietary to these Malaysian companies. And it's actually quite sophisticated. So you can't buy the technology. It's a purpose built. And then the second thing is the feedstock for gloves is rubber, which is a very heavy, low value item. You can't ship that around the world because it destroys the economics. You actually have to have plants neighboring the feedstock, which is largely Malaysia. So it actually is an extremely difficult market to get into. And this is why Top Glove and the Malaysians have ended up controlling about 85% of the world market for rubber gloves. There is a bit of alternate supply from China, but it's actually at a relatively low quality. And so for hospitals in the medical area, the Malaysian industry, particularly Top Glove and Harder Glove, they have an outstanding track record in terms of product integrity. So if you're buying gloves, people are not risking it in buying gloves from China. You might, if in certain low value sort of examples, but in most areas, they just don't want to take the risk. And it's actually a very low value item. They sell for around $28 per thousand. So, you know, they're only a few cents each per glove, like 3 US cents each. So it's not an item that you want to economize on. You really want to have an item with a lot of integrity. So for all these reasons, despite the boom in the industry, it's extremely hard for capacity to come in over the next 4 or 5 years. So we actually think these profit pools are going to remain high, in fact, get higher over the next 2 or 3 years.
Great, thank you very much. That's all the questions we've got time for today. So I'd like to thank Patrick for your time and everybody listening at home. I hope you've gained some valuable insights and enjoyed hearing about Northcape. If you have any further questions or would like any more information on Northcape, then please feel free to contact us and we'll be happy to help. Do also keep an eye out for an invitation to our next Fund Manager webinar, which we're going out shortly. And yeah, thank you again for listening and enjoy the rest of your day. So, thank you.
Thanks, Kane. And yeah, thank you for your attention today. We appreciate the opportunity to go through the strategy with you.
Great, thanks. Bye.